Hi everyone, I hope you're doing well. And today we're going to be doing an LBO model, not from scratch, but I'm going to give you a bit of an overview of how we can build one and how it's done. So basically, I've uploaded this exercise on my website, which you can find on Gumroad in the description of this video. So basically, it's a training for an LBO model, a pure LBO model. So I've divided into two parts: an exercise part where basically you have your assumptions just like you would have in real life during an interview. So you have nothing, pretty much, you have your assumptions, and then you have to fill pretty much everything. Same for the cash flow statement, and same for the full LBO model. Basically, I've added a kind of a bonus part, which is a three-statement model you have to do and link it to the LBO. So it's a very complete exercise, and I really suggest you to do it from the beginning. First thing first, before we dive into the LBO and how it works, in pretty much I'm going to try to do it quickly. I'm just going to give you guys a bit of information. So first thing to do is look if your formulas are basically automatic. I'll put automatic. This is very important. And the second thing is if you check your settings, so you go to options, you go to formulas, and you have iterative calculation enabled. This is very important because you will be doing some kind of computations that require some part of the formula to be linked to the result of the formula itself. So we can catch up on this maybe a bit later, but these are the two settings you need to check. Don't bother changing this and this. Leave it to 100.001. This is very good. So let's get into the LBO now. So what we have right now is basically first thing first, what do you do when you start an LBO? So for example, you're in an interview, you're talking to the interviewer, he says, okay, I'm going to give you a computer. It happened to me a lot of times back in the day when I was interviewing. They would give you basically a complete blank Excel sheet, and they will tell you, okay, this is an LBO. They'll give you a paper, and they will give you a few assumptions. Basically, what are the assumptions we could give you? Well, here I have simplified them for the sake of the exercise, but you can have more complicated ones. So I'm going to give you a bit of an overview. So this we can trash it. There's no need for this. So I'm just going to put in yellow. So what we have is first we have a multiple. This is very important to understand is that when you buy a business, when you evaluate a business, when you do valuation, a price is never, and it's very important for you to note, it is never given with an absolute value. By that, I mean that every price you will see will be given in a multiple format so that you can compare it with other ones. Because if I tell you this shoe costs $100 and this other shoe costs, I don't know, $3,000, of course you're going to say, oh, but the one that costs $2,000 is more expensive. But if I tell you that the cost to produce this shoe are higher, then the multiples of 3,000 divided by, let's say, costed 2,000 to make, and the other one had a lower multiple, you would see that actually the one with a lower price would be more expensive because it would cost more on a relative basis. So this is very important. So the multiple is basically enterprise value divided by EBITDA. So this is a way to compare apples with apples and oranges with oranges. Okay. So now you have your entry multiple. So basically this is when I buy the business. This is very important. And here you have your exit multiple. So same thing, but when I sell. Okay. So this is very key to understand because these are the two assumptions, major ones. Now you're going to put the duration. So how long am I going to keep the company for? So I'm expecting to sell it because we're going on the basis that we are a financial sponsor. So I'm going to sell this business. So let's say for 5 years. So if I buy it, for example, we're in 2025 now. So if I buy it, I have this plus 5 years. So it will be in 2030 exit. Okay. Okay, so basically I did the computation here, which is pretty simple. You add, okay, and you have an entry date as an assumption. Then you will have an assumption, a tax rate, depending on the country you're in. So let's say we put 25%. You would have to check if your country has a different tax rate. You put acquisition fees. I'd suggest you to leave it at 3% because this is basically the result of all the fees you have when you buy a company. So it could be legal fees, it could be M&A fees, it could be a lot of stuff. And then you have your cash surplus. So this is purely hypothetical here. You have more cash on the balance sheet. Then you have your leverage, which is very key, 5 times. Basically, this means that if I buy a company that has, for example, 50 million EBITDA, then I will put 250 times 250 million in debt. So this is the debt you're going to raise for the transaction, including the debt you're going to refinance. So you're going to buy from the company and you divide it by the EBITDA. Okay, so now you have your first, let's say, debt overview. So I give you as assumptions senior A, senior B, unitranche. To show you, it looks like this when it's not done. So I have given you, these are hypotheses, everything in blue. This is a color cartoon. Everything in blue is hard coded. Everything in black is a formula. See, this is a formula. Okay, so now you see basically your leverage. So these are the assumptions. I'm going to tell you you have a senior A. So A for amortized, because it's the first one, it's amortized. So basically you have to amortize the debt along the duration, so 6 years with 2 times leverage, so 2 times EBITDA with a 7% amortized, 7% interest rate. You have a senior B, which is bullet, so it's in fine reimbursement, same with your insurance, and then you have PIK, and then your revolver credit facilities and some cash interest. So the first thing you have to do when you start an LBO model, so we start now, is you have to go for the sources and uses. This is very important because it shows where the money comes from and how I'm going and where am I going to use this money for? What am I going to use this money for? So here we have your uses and your sources. So I suggest you start with sources. Basically, where is my money coming from? First, I'm not going to put equity, I'm going to put debt because I have a leverage assumption. So I know I'm going to do 5 times the debt. Okay. And so if you sum this up, it goes to 5. So I know this whole thing is 5 times. So I'm going to put first all my leverages, and then I compute with the EBITDA, and then the difference is going to be my equity value. Now, what you have to do is, I said you can start from sources, but it's more logical if you start with the uses. So what you do is you basically have your enterprise value, which is your entry multiple times your EBITDA. Now you have your gross debt, which is the one on your balance sheet, not the one you're going to raise. Because look here, if I take this sum, I have 9,000, but my net debt on the balance sheet is 7,000. So I refinance this debt. Net debt is gross debt minus cash. So if I refinance this debt, I'm going to have 2 billion more. So because this is, oh, it's in K euros. So okay, so 2 million more than what do we have? And then we have the equity value, which is just your usual bridge. Very here easy. You have your enterprise value, and then you get your equity value by removing the net debt. Okay, you have your surplus cash as I said at the beginning, and your acquisition costs, which we can't see now because it's cut. Okay, so you have your uses, and then you know that it's going to balance. So you just balance, and then you put your equity as the difference. This is one way to do it. In reality, we wouldn't do it like that, but in terms of training for an LBO and a case study, this is a good way to do it so that you're pretty sure that it balances. Okay, because everything you raise is going to be used. Okay, so now we start with the business plan. I'm not going to go deep into this because I don't want this video to be too long, but what I'm going to say is very simple. 2 things to know. Here it starts with EBITDA, but you would have revenue, and what happens is that usually you have a revenue growth hypothesis and you have, let's say, so if I give you an EBITDA margin hypothesis, let's say for example 30%. So basically how we usually do it is I give you a growth hypothesis for assumption, sorry, for the revenue. So let's say for example 2% per annum, and I will give you a margin assumption for EBITDA. So basically I'll tell you, oh, the margin remains the same along the business plan, or you gain 1 or 2 points. Okay, so you could have for example a ramp up and a run rate. So you could have for example 20% for the first, let's say 3 years, okay, and then you would say for example, I don't know, 25%. Okay, so this is an example. So this we don't need. So you start with EBITDA. We have it because remember we did first a 3-statement model, so it's linked to model and solution 109. So if you're going to check 109, if you're going to check here, we have done a pretty simple 3-statement model so that you understand how it works. Okay, I did both so that you can train with a simple document, and you can literally, with this document, you can understand all the dynamics you need to do an LBO. So now you have your, basically, you go back to your free cash flows. This I'm not going to go over, it's pretty simple. And then what happens is that here there's something important to know. I said we go to the free cash flows, but can you see something that is very important here? This line, because this line is linked to basically your whole debt schedule. Okay, so what you have to do is a debt schedule. So it's a reimbursement of the debt over time. So it starts with the debt, then you reimburse some part, then you have an ending date, and you have basically your interests, and then you have your beginning debt the next day and everything. Okay, this is very important to know. It is that, for example, here there's a linear amortization. This is what we do in business. So basically you divide by the term your quantum of debt, then you do your debt schedule, and you'll try to link it. I'm not going to give you the solution. You can see the numbers right now. These numbers are the answer. Is the answer. You will be able to have the answer in the document, but I'm not going to go over these because it will take too long. But try to familiar yourself to get more familiar with this, with the links you can do between the free cash flows, the interest and stuff like that, because it's very important. And now I'm going to go over the exit, which is pretty simple. Every LBO, the output of an LBO model is a MOIC, or we can call it MOM. So we can call it MOM, or money on money, or multiple of invested capital, and an IR, which is an internal rate of return. Okay, so basically what it means is that I both measure how much I make. So for example, if I had invested 100 and I do 1.4 times MOIC, it will mean that I would get, so it's rounded, it's 135, so I'll get 135 euros. But now I need to understand how long it took me to generate this value. And that's where the IR comes from. Because if I take 100 and during 5 years, this 100 grows at 5.1% per annum, I'm going to get this 135. So this gives me an idea of the time value of money, and this gives me an idea of the absolute return. So basically here you just have a bridge at the end. So if you go into 5 years, so we said that the entry year was what we said 2019, 2024 as an exit. Okay, so here I linked it pretty dynamically so that I have it. Well, I just have a bridge. So basically you have your exit equity value, which is your EV minus, as I said before, your net debt, and then you have your proceeds, which are just basically your equity value, and then you divide the equity value at entry, which we had here in our sources and uses, and then you divide the exit by the entry, it gives you a multiple. And then the IR, I suggest you use the formula called XIR, which basically takes your values, or I could go just up to here, and then your date. Be careful, it has to be in the date format, so always with a day, a month, and a year, and it will give me this, which is exactly the number you have here. Okay, and now I suggest you to get familiar as well with the sensitivity tables, meaning, for example, this type of stuff where you get actually, you can take some different variables and understand how they impact the performance of your investment. So for example, here what you have is, you have one that will change your entry multiple and your exit multiple, and will give you your IR in function of that. And this, it will have the revenue growth and then your entry multiple. So this every time here you have to have something that is linked, and I will let you play with this, and you have any question you can put me in the comments, because what we'd have in practice, I will just give you an example. In practice, the sensitivity table I would put in my IC memo, for example, in PE. In investing, you would have the IR. So for example, you would have 13.1%, and you would have 1.4 times. For example, this is what you would have. So here we just did it with the IR, but you can do it with the multiple as well. This is something you can do, and basically you have it here. Okay, so right here, try to do a good exercise is try to do this type of stuff dynamically, because I've put in hard coded right now, but you can do it dynamically and try to understand how it works. Okay, so here, to give you an example, I did with a multiple. So you see you have 135. Usually you have to check the middle. because your middles are your assumptions. So usually try to check if the middle aligns with what you have in your model. Here it works because you have 135, 135, because you are 10 and 10, which is an ISO multiple assumption. I hope this video helped you a bit on the exercise. Don't hesitate to leave comments so that I can answer, or if you want any other video you want me to work on or show you anything, you can tell me, and keep me posted on how you work. Bye bye, guys.